Okay. First of all, allow me to welcome you to our more or less quarterly update that we carry out on financial markets, macroeconomic prospects with particular attention to currency markets. I will try to make it worthwhile for you. Obviously, this quarter's webinar is going to be focused on the terrible events after Russia's invasion of Ukraine and the impact that's going to have, and it's having already, financial markets, macroeconomic prospects, and in particular currency markets. So if we go to the next slide, this is the structure of the presentation today. First of all, we're going to have a look back at how the markets reacted so far. What are the macroeconomic implications and more importantly, what is becoming quickly the most critical aspect of or currency markets of the world, which is central banks' potential reaction to that. How will they react? Will they accelerate the path of hikes? Will they sacrifice economic growth for the sake of controlling inflation? This is a problem that is being rendered much more difficult by the war. Again, in the second part of the presentation, we'll focus on the big three central bank meetings, the ones that are probably most important for the attendees of this webinar. Obviously, the European Central Bank, the Federal Reserve, but also the Bank of England. And then hopefully we'll have some time to do a Q&A session, take some questions, and try to clarify further what we think is going to happen in currency markets for the remainder of the year. So if we go to the next presentation, the next slide. Obviously, as one would expect, the first immediate reaction to the events in Ukraine was a significant sell-off in markets. The reality is that nobody was really expecting at least not to this extent, the problem to degenerate to an outright full invasion of Ukraine by Russia. The initial move was a classic risk-off reaction. High-risk assets like stock, bonds that had great exposure were sold off in favor of the traditional safe havens. This was positive for the Swiss franc and the yen. Russian sanctions, the sanctions imposed on Russia by the international community were probably the harshest that has ever been imposed outside of possibly North Korea and Iran. They are as aggressive as they can be, I think, without going to a full economic blockade of Russia. And the one reaction in markets that we saw that is different from past crises is that commodity prices spiked. It makes sense because Russia is a massive provider of energy, oil and gas. Ukraine is a key player in agricultural markets, particularly the exports of wheat and some vegetable oils. There's been a near panic in commodity markets. Some of them actually had to be closed, and commodity prices are now considerably higher than they were before the invasion. And this comes on the heels of significant increases in commodity prices in the previous 12 months. So we're starting to see preoccupation in governments, central banks, and increasing among businesses and workers about the spiral higher of commodity prices. We think that the crisis is inflationary. The risk to near-term growth have been heightened, but we think that the primary impact of the crisis is to reinforce the inflationary tendencies that had already worrying central banks, to finally bury any sense that these inflationary pressures will be temporary. And this has made central banks' job that much harder. The impact of monetary policy is not clear. I think that we're seeing some hesitation and perhaps unclear communications from the European Central Bank and the Bank of England, in the sense of they don't know how to react, whether this is going to require further and faster tightening of monetary policy to suppress inflation, or on the contrary, to delay the tightening of monetary policy to support growth. The Federal Reserve, on the other hand, has been much more clear. that especially after Powell's speech yesterday and the meeting the previous week, that getting a grip on inflation takes precedence. And so we've seen a significant sell-off in bond markets worldwide, in particular in the US. The interesting aspect is that risk assets, however, have largely rebounded, and that Euro stock is back. For instance, the European stocks are back at something close to the levels that were before the invasion, which is quite surprising. And we'll talk about that a little bit later. If we go to the next slide.
Yes, thank you, Enrique. There's actually a bit of background noise on your end, so I might possibly take over from you on this next slide. That's okay.
Okay, that is fine.
Sorry about that. So we're moving on now. Very much the main focus among market participants remains the war in Ukraine. We've outlined here what we think are three major consequences of the war. First of which we've been mentioning is a sharp increase in inflationary pressures. We've seen a big boom higher in commodity prices as a result of the war in Ukraine. Inflation was already highly elevated leading up to the invasion, and that increase in pressure is due to be noticed in the upcoming inflation prints, which we think are now more important than ever. Well, we're also seeing a disruption to commodity markets. As I mentioned, energy prices in particular have risen rather sharply, and we expect higher prices to weigh on growth, particularly among the G10 nations in the near term in 2022. And in fact, we've seen a number of the major central banks have already revised lower their growth forecasts for this year, partly in reflection of higher commodity prices. And this is creating a very difficult dilemma for central banks. They're sort of caught between two minds in terms of, first of all, reining in inflationary pressures by raising interest rates aggressively, but also there is this risk to growth, which may prevent a more aggressive pace of tightening. We've seen, for instance, the Bank of England, which has already indicated in its March communications that it may potentially have to pause the hiking cycle at some point later this year in order to cushion the economic hit from this increase in inflation, particularly rising commodity prices, which are out of central banks' control. But as you can see, even prior to the war in Ukraine, inflation was rising very aggressively among the major nations. We've seen multi-decade or record high levels of price growth among most of the major economic areas, particularly in the US, but also in the Eurozone and the UK. And this is prior to the invasion. So this data covers the pre-Ukraine war, Russia-Ukraine war period. Since then, we've seen a continued move higher in commodities, particularly the likes of natural gas, oil, have risen rather sharply, albeit we have seen a little bit of a retracement. It's still leading to this increase in inflationary pressures. Most of these inflation prints we think have room to run. As I said, central bankers have revised higher their inflation projections. We expect an even greater overshoot relative to central bank targets than what we've already seen. And that creates a very difficult environment for these central bankers. As I said, probably likely to continue to raise interest rates aggressively this year, but also they'll be wary of the potential negative growth implications from this increase in commodity prices. But how have markets reacted so far to the war in Ukraine? Well, we'll start with the initial market reaction, and markets reacted in a classic risk-off fashion, as one would expect. Well, we saw investors piling into the safe haven currencies and safe haven assets at the expense of the higher risk ones. So equity markets sold off across the board, particularly in Europe. Russia's stock index, unsurprisingly, suffered a record sell-off, but also in the rest of Europe, we saw quite a significant move lower. Most European equity indices were down sort of around about 5% or more at one stage during the initial market panic. The safe haven government bonds also rallied. It's increased in value, leading to a move lower in their yields due to the inverse relationship between the two. Perhaps though the most noteworthy move that we noticed was the sharp increase in commodity prices, particularly oil. Brent crude oil smashed through the $130 a barrel mark following the strict and tough sanctions that were imposed on Russia's economy, particularly its oil sector. Again, we have seen a little bit of retracement, which we're going to talk about in the next few slides, but prices remain elevated, particularly commodities, and that presents a significant risk, as I said, to the global economy. Among the major currencies, again, we saw investors reacting in a risk-off fashion. The safe haven currencies rallied, the dollar, yen, Swiss franc, much like it did at the beginning of the COVID-19 pandemic. The US dollar has emerged as a safe haven currency of choice, largely due to the US economy's lack of reliance on the global economy for demand and its relative resilience relative to most of its other major peers. Those that suffered the greatest sell-off tended to be those in Europe. As you can see, this chart represents the FX performance of the G10 currencies a week following the invasion. Most of the European ones underperformed. Swedish krona, for instance. Euro and sterling were also dragged fairly significantly lower. Among the emerging market spectrum, those in Central and Eastern Europe were particularly hard hit. We saw record low levels in the Polish zloty, the Hungarian forint, in large part due to both the close proximity of these currencies and countries to the war and to the conflict, but also the close economic ties of those economic areas. And that's generally, we think, why we've seen this underperformance in the European ones at the expense of those that are perhaps slightly more detached from Russia and demand or oil trade, I should say, or energy trade from Russia. So the likes of the Canadian dollar, Australian dollar actually outperformed. That's a bit of a counterintuitive move, you would say, in a risk-off environment. Those currencies would tend to sell off, but they actually rallied, both due to their lack of demand or lack of reliance on Russia and higher commodity prices. Among the rest of the EM, probably the most notable moves have been, first of all, the increase in commodity-dependent currencies. Actually, one of our favorite currencies, the Brazilian real, has rallied very aggressively, given this boom in commodities. And also, actually, we saw an outperformance in those in Asia, particularly the Chinese yuan, which continues to remain very resilient. Again, we think this largely has to do with a lack of dependence of these economies on energy trade with Russia relative to most of the European ones. Now on to Roman, who's going to talk about how markets have rebounded following this initial sell-off.
Thank you, Matthew. So after a few weeks of panic, the markets seem to have gotten a bit used to the situation, and they have started to reassess. They have also been quite optimistic, particularly at the beginning of last week, after we have received information that the talks have made significant progress. This information has been from both sides, and Kremlin is said to be putting colossal energy into discussions, although here I would mind you to take it with a grain of salt. That said, the negotiations were supposed to be going well, at least at the beginning of last week. And in the past few days, we have also received information that Ukraine appears to be willing to compromise on NATO. This is a statement that President Zelensky has said repeatedly. So it seems that this could bring further progress and hopefully the end of war. The situation with the risk assets has improved because of that. We have seen European equities rebounding and recovering practically all of their losses. The USD has stopped appreciating, although it still remains elevated and just shy of May 2020 highs. Generally, for the situation that we are dealing with, the European currencies are performing well, and the market is signaling its optimism. The euro dollar has rallied back above the 110 mark, and the CE currencies have recovered greatly. The Polish zloty and the Hungarian forint have recovered from the record lows. and we are seeing that it has both been a function of improved sentiment as well as a swift and aggressive response of the country's central banks and other authorities to the situation. Could we move on to the next slide? But the primary victim of the situation, if obviously in the FX terms, have been the currencies of countries engaged in war, so Ukrainian hryvnia and Russian ruble. The ruble has fell to a new record low of 150 to the US dollar, although as other currencies in the region, it has recovered a large portion of its losses amid improved sentiment, also amid actions of its central bank that has been intervening in the market and that has engaged in a massive interest rate hike, bringing rates effectively more than doubling rates when the pressure hit the ruble. At one point, swaps indicated that there was a 80% chance of a Russian default. We have seen that the rating agencies have significantly downgraded the ratings of Russia, although the worries in that regard have eased since, and the swaps have corrected. The central bank and the government of Russia have engaged in ways to stem the ruble depreciation. They have suspended the sales of foreign currency, introduced new laws, and this all was made to help stabilize the exchange rate. There are also some suspicions that the situation with the Russian ruble and the currency's recovery has to do with a relatively favorable current account situation. Before the war, Russia has recorded a record current account surpluses. So this might also be the reason for the ruble to be performing the way it is. Can we move on to the next one? The CEE currencies have been selling off very rapidly at the beginning of the crisis, and to approximately 7 or 8 of March, when they have reached their record lows, at least the Polish zloty and the Hungarian forint. In case of the Polish zloty, it has been 5.0. It has been pretty much panic because we were seeing that the exchange rate can move by 10 groszy or even more on a day, and it has crossed the levels that it has never before crossed in history. One part of reason for that was that the currencies have already been quite low because they were battered by the pandemic and by other issues prior to the war in Ukraine. But this situation has put additional pressure because of the close proximity to the conflict. Ukraine is bordering Poland, so it's natural that the currency depreciated. Poland is also quite reliant on Russian energy imports, although it doesn't have a very strong economic relationship with Russia beyond that. Generally, the zloty is also a highly liquid currency. Overall, the currencies in the region are liquid, but the zloty primarily. So to exit the region, investors might have chosen to do so by selling off assets nominated in the PLN. Also, those currencies are risk sensitive by their nature. They are EM currencies. So whenever there is an increase in risk, they are reacting significantly. So the losses that we have seen for the forint and the zloty have been at approximately 9%. Looking from before the conflict to the peak of fear. For the Czech koruna, it has been somewhat more limited. And this can be probably explained by difference in fundamentals, among other things. But right now we have seen that a pretty significant correction with regard to exchange rates. For instance, the zloty has moved from 5.0 to 4.7% in a very short period of time. Let's move on to the next slide. One of the reasons for this improvement, in addition to improved sentiment, has been the support from the central banks and overall authorities. When the war started, the banks started sending signals that they may step into the market. And in fact, the Polish Central Bank and Czech National Bank have done so. There is no confirmation of Hungarian Central Bank. However, it all central banks in the region have some capacity to act. One key measure to see how much capacity they do is to look at their central banks' FX reserves. And we can look at the nominal number, and we can also look at the months of imports, because at certain points of crisis, a central bank can effectively pay for imports with hard currency to facilitate the situation. So this is one of the key measures, probably better than imports to reserves to GDP. So countries such as Poland and Czechia, they have respectively approximately 5.5 or 11 months of import cover. Hungary has about 3.5 months of import cover. The typical ratio that is considered safe is approximately 3 months. So by this, all of those countries have the ability to support the exchange rates. But if we take a more conservative look, Poland and Czechia certainly have the means to do so. And also looking at the exchange reserves, we are going to talk about a situation in Russia a bit more, but it's not only how much reserves you have, but it's also whether you can count on some support. And in the situation where a central bank of an EU country would need support, there is a strong likelihood that they would actually receive the support from the European Central Bank by the ECB providing them with swap lines. We so far haven't received such information that this will be the case. However, the Polish Central Bank confirmed that the talks are ongoing with major central banks. So this is something that the banks can probably count on. Ukraine, for instance, has received a swap line with the National Bank of Poland to support the functioning of Ukraine's financial system. It's up to 4 billion zloty, so it's not in any way threatening to the Polish financial system, and it can help Ukraine. Another way to support the exchange rate is by raising interest rates. This is something that Russia has done. This is a typical thing in the playbook. And the central banks in the region have also engaged in tightening through raising rates. They have already been on a way to tighten monetary policy, but they have hiked more because of the situation. The National Bank of Hungary has engaged in a weekly setting of a 1-week deposit rate. And this is the rate that is right now key for the market. And it has hiked more than expected. The rates are right now close to 6%, but they will be higher, at least according to the market. The Polish Central Bank has hiked rates recently by 75 basis points to 3.5%. This is more than expected by the consensus, and this is more than could be reasonably expected before the war. And part of this tightening is due to the situation in Ukraine. So the central banks are trying to stabilize the exchange rate. There also need to counter the risks that this war in Ukraine has on the domestic economies, because it's quite obvious that this will lead to higher inflation. Also, this will negatively affect growth. And this also is a terms of trade shock. So central banks need to address that. And considering that the inflation in the CEE is already high, they need to do everything they can to limit the likelihood of a further deterioration in the situation. Please move on to the next slide. As I said, after the war broke, the market started pricing in more tightening from the central banks in the CEE. This has been particularly visible if we look at the pricing for Hungary's rates. Right now, the market is implying that the 3-month interbank rate in 6 months will move close to 8%. In Poland, it is expected to move close to 6%. In Czechia, the difference has been the smallest, but the central bank has been one of the most active globally in tightening policy, and rates in Czechia are already the highest in the region, looking at the central bank key rate. Generally, in case of Poland and Hungary, what we expect, or what the market expects, should I say, is approximately 200 basis points of additional tightening. Those expectations seem to be right now quite elevated. And we expect that, for instance, in Poland, rates should move by approximately 100 basis points. However, the situation is constantly evolving, and practically every week can bring a shift with regards to the expectations towards interest rates. And the primarily driver of those interest rates in the near future will be the war in Ukraine, because of the effect it has on the exchange rate and because of the shocks that it brings to those economies. Let's move to the next slide. Going back to the situation in the main markets, we have seen that the euro-dollar has stabilized, although it is still quite weak. It is shy of its lowest level since May 2020. This has to do with the location and dependence on energy imports from Russia. Looking at gas imports, close to 50% of those have been from Russia. With regards to oil imports, it's slightly less, but it's still significant. And generally, this situation that we are dealing right now leads to a terms of trade shock. So it's quite unfavorable, and fundamentally is something that is pulling the euro down. We've also, as mentioned, this situation is negative for growth. And we have seen some early signs that this will be the case with a decline in the economic sentiment indices from ZEW that collapsed in March. It has been quite brutal, although one needs to take into account that those are sentiment indices, so they are basically expectations. They do not really need to one-to-one translate into the economic situation. They are soft indices. Also, looking at the exchange rate again, the volatility situation has changed significantly from the start of the war in Ukraine. The volatility has increased to the highest level since the start of the pandemic. It still remains elevated, although as with many other currencies and assets in the past days, some of this increase in volatility has declined. The volatility has dropped to slightly more normal levels. Generally, another factor that has been supportive of the euro is the European Central Bank. The recent meeting in March has been more hawkish than expected. We'll talk about it a bit more later, but a hawkish central bank is generally a positive for a currency. Let's move on to the next slide. Generally, what we have seen, in addition to shifts in the exchange rates, has been a shift in the commodity prices. Not only the energy prices, we've already mentioned increase in oil prices and gas and other prices, but also certain soft commodities. Ukraine and Russia are the countries that are producing a lot of wheat and maize, and those prices have jumped by approximately 35–50%, and they still remain elevated. Also, we have seen a significant increase in prices of metal, in particular palladium, that Russia is one of the main producers. Looking broadly at the Bloomberg Commodity Index, the price index has increased to 140 at one point, so 23% from the start of war. However, since then, it has retraced much of its gains, slightly more than 50%. Also, the commodity currencies that have benefited because of the invasion and increase in commodity prices have reversed some of their gains, and examples here include Canadian dollar, Norwegian kroner, and Australian dollar. Let's move on to the next one. That said, particularly looking in currencies in Latin America, those currencies still remain quite well supported. We have seen a little bit of a correction here and there. For instance, the one that has been performed particularly well, the Colombian peso, has given up some of its gains. That said, for instance, the Brazilian real, one of our favorite currencies, is trading more than 10% higher than at the beginning of the year. So increase in commodity prices, the fact that they are still elevated, and some upside risk possibly also keeps some support for the Latin American currencies. Right now, I'll pass on to Matthew.
Yes, thank you, Roman. Very quickly following the initial market panic at the onset of the invasion, attention among investors turned to the potential economic ramifications of the war, particularly those stemming from the various unprecedented sanctions that we've seen imposed on the Western world on Russia, intended, of course, to punish the country's economy and financial system. Of course, we've seen a variety of different sanctions imposed, some on President Putin himself or the Russian oligarchs. Those that the market have been most concerned with have been those that we think target the Russia's financial system and trade and the country's central bank. We've outlined here what we think are the most significant ones, starting with the removal of a number of Russian banks from the SWIFT international payment system. This effectively enables the transactions of currencies across borders, so it is an effective block on Russian exports and imports. We've also seen some significant and unprecedented measures imposed on the country's central bank. A variety of countries have come together, the US, European Union, the UK, Canada, for instance, to block Russia, the Bank of Russia, from using its vast hoard of foreign exchange reserves denominated in their respective currencies. So the Bank of Russia is now unable to use its euros, dollars, sterling that is accumulated over the years to protect the currency. Around about 55–60% of overall reserves held at the Bank of Russia are denominated in these currencies. So that significantly limits the ability of the central bank to physically intervene in the market in order to prevent a significant sell-off in the Russian ruble. Also, what it does is it limits the ability of the bank to deter speculative attacks on the currency. During the years of high oil prices, the Bank of Russia has been able to accumulate a significant amount of FX reserves. That deters speculative attacks against the ruble. But now that the bank is unable to use more than 50% of those reserves, we have seen a significant sell-off in the ruble. And actually on the Monday following the weekend that the news broke, the ruble was down at one stage around about 30% against the US dollar for one day, which is a significant move by any accounts. We've also seen these countries, particularly the US, ban transactions with Russia's central bank. Again, it's another ploy to limit the ability of the central bank to intervene and protect the ruble. So this effectively provides a visual representation of what I've been talking about. Here you can see the breakdown of Russia's FX reserves by currency. And due to this freeze of more than 50% of those currencies, which is actually even higher once we exclude gold from the reserves, this significantly limits, we think, the ability of the central bank to intervene by selling its foreign currency and buying domestic currency, by buying rubles in order to prop up the currency. As I said, the investors reacted aggressively to the news that the ruble fell to a fresh record low. We have seen a little bit, well, quite a significant recovery actually, albeit the ruble has not managed to recover all of its losses. Partly that is a result of an easing and an improvement in market sentiment towards the conflict. Also, the Central Bank of Russia has used alternate measures in order to protect the ruble, including raising interest rates aggressively. Rates were hiked to 20% in a massive single rate hike move. And the central bank has also banned sale of local currency by foreigners in order to, attempt to stem the outflow away from the ruble. The problem with the weaker currency is, first of all, it's inflationary. We're likely to see a significant increase in inflation in Russia. It also increases the cost of repaying foreign debt. Hence why we've seen a significant increase in the market implied probability of a Russian default. While we have seen that rebound, of course, with the central bank having limited ammunition now to protect the currency following this ban, further depreciating pressure on the currency is likely, and we think that the ruble remains susceptible to additional losses. Now, while the impact of the aforementioned sanctions on the Russian economy is likely to be very severe, actually we think that the impact of those sanctions on global growth is probably likely to be relatively minor. What the market will be concerned and is concerned is the sanctions that have been imposed on Russia's energy sector. We think these present the biggest risk to global growth. What we've seen have been very significant sanctions announced by some of the major economic areas. The US has put an immediate ban on all imports of oil and gas from Russia, effective immediately. The UK will phase out oil by the end of the year, while the EU will gradually reduce its dependency on Russian imports of oil and gas by around about two-thirds by the end of this year. Slightly less aggressive measures from the European Union, given the much higher dependence the EU has on Russian energy than many of its peers. Oil prices increased very aggressively as a result of these sanctions, albeit we have seen a little bit of retracement. But the general consensus is that we could see a continued move higher in oil prices, particularly should other nations follow suit with these harsh sanctions on Russia's energy sector. Now, of course, the big risk to the global economy is the collateral damage that we're likely to see because of these sanctions. Particularly, I would highlight the European Union. Actually, if we look at the US and UK, the dependency of those economies to Russian energy is very low. Imports of oil, for instance, to the US and UK is around about 10% or less. So the significance is relatively minimal from a ban for those countries. Actually, for the EU, though, that's much higher. The EU, I think, is around about 30% of all oil imports are from Russia, and around about 40% of its gas imports are from Russia as well. So a very high level of dependency. The sourcing of sort of alternate energy sources is not going to be a quick fix for the European Union, and that's raised significant concerns, heightened concerns over not just European growth, but global growth as well. Partly why we've seen this risk-off mode in markets for the most part in the last few weeks. We've also seen central banks revise lower their growth forecasts due, first of all, to the disruption in energy trade, but also following this sharp increase in commodity prices, which central bankers think is likely to weigh on growth during the remainder of the year. But all in all, it creates a very difficult scenario for these central bankers as they try and both rein in inflation, but also support economies from the shock. But what are the macroeconomic implications? Well, the first things first, the clear impact we think is going to be on the Russian economy. We expect it to head to a brutal recession this year. In fact, Fitch rating agency has now expects the Russian economy to contract by 8% in 2022, which is obviously very significant. We expect this to drag the European economies, I should say, with it, particularly those that are heavily dependent on Russian energy trade. Those in Central and Eastern Europe, we think, are particularly susceptible to a slowdown, with the euro area probably not too far behind. Again, Fitch is expecting a 1.5 percentage point decrease in euro area growth due to the impact of the war. Actually, though, the global impact might be relatively minor. The US, for instance, Fitch again has only shaved 0.2 percentage points off its growth forecast for the US, and only 0.7 percentage point over the global growth forecast. So while we expect Russia, the neighboring countries to experience quite a significant economic hit, actually we think that the global economic repercussions will be certainly non-negligible, but rather contained. The bigger risks we think to global growth will stem from a worsening in business and consumer sentiment to start with. As we've been saying, the sentiment indices that we have had in the last few weeks have deteriorated quite sharply, particularly the ZEW Economic Sentiment Index out of the Eurozone. we'll get the first real reading of the potential impact on the major economic area growth on Thursday with the release of the latest business activity PMIs. We expect a deterioration there. Supply chains are also likely to be disrupted. That was already an issue even prior to the war, given the impact of COVID. We expect that to worsen. And as we've been saying, rising inflationary pressures, inflation has increased sharply, particularly due to the boom in commodities. We expect that to weigh on growth further during the remainder of the year. And stagflation, this narrative whereby we're getting slowdown in growth and rising prices, we expect that to become increasingly important in the coming weeks. One of the impacts, of course, that we've been saying of the war on the global economy is on inflation. Even prior to the war, inflationary pressures were elevated. We had multi-decade or record high levels of inflation in some of the major economic areas. We expect that to worsen as a result of the war in Ukraine. First of all, given this increase in commodity prices, also given to this disruption to supply chains, which is also already relatively fragile, particularly in China, given the zero COVID policy that has been imposed there. And this creates a significant headache for central bankers. Most, as we've been saying, have revised their inflation forecast for this year sharply higher, but also remain slightly wary of the impact of higher commodity prices, higher energy on growth in their respective countries. So that's going to be a key theme, we think, in the next few months of central bank meetings. How do these policymakers balance reining in inflation, but also supporting their economies still, particularly in the second half of this year, once the impact of the war feeds its way through to higher domestic prices? As you can see, though, from this chart, inflation is already booming in the G10 countries. This represents the inflation overshoot, so current inflation relative to central bank targets. As you can see, inflation is already far exceeding these targets in most of these major nations. Actually, 9 of the 10 are now seeing an inflation overshoot, particularly like the US, Eurozone, UK. And the worrying, concerning thing is there's been no signs yet that inflationary pressures have peaked. We're likely to see these overshoots increase in the coming months. Inflation prints in the next 2 or 3 months or so will be important, more so than before. Ultimately, though, what this does is it reaffirms the hawkish stance of some of these central banks, most of which have either already started raising rates or have indicated that higher rates are on the way. Actually, more than half of these central banks now expect to raise rates by 100 basis points or more in 2022, which is a complete departure from what we saw certainly in the immediate aftermath of the financial crisis in 2008, 2009, where that removal of accommodative policies was very much a slow and steady one. This is a very significant shift away from that to one that is much more hawkish and aggressive when it comes to raising rates. But how might central banks react to the war? Well, as we said, in the immediate aftermath of the invasion, we thought that the crisis was dovish in the near term, but actually hawkish in the medium term. In the immediate term, we see risks to global growth. We see heightened uncertainty. There's no knowing as to how long the conflict will last, or actually what the near-term economic impact will be until we start getting economic data. So that is a little bit of caution among policymakers in the near term. But in the medium term, we think it's hawkish, given this increase in inflationary pressures that we've talked about. On the whole, so far, we've seen that play out, we think. All of the major sort of big 3 central banks have met since the start of the invasion. Actually, prior to the war, we thought we'd see 50 basis point moves from the Fed and the Bank of England. Actually, what we got was 25 basis point hikes. So slightly more cautious in the March moves. But actually, over the longer term, we expect these central banks to continue raising rates aggressively. And the Federal Reserve for instance, has outlined a very aggressive pace of hikes during the remainder of the year, more so than what they thought prior to the invasion. But that's going to be the focus of the next few slides. I'm going to pass over to Roman first of all, who's going to talk about the European Central Bank meeting in a little bit more detail.
Thank you, Matthew. So going back to the European Central Bank, the March meeting was quite interesting in that the markets didn't expect what we received, and particularly a recalibration to the APP program. The pandemic asset purchase program was set to conclude in March. However, to smooth the transition from the PEPP to the APP, to normal asset purchases, to avoid a cliff edge scenario, the central bank previously decided to increase temporarily APP before its return to a 20 billion euros per month. And this assumed that we are going to have 40 billions of purchases in the second quarter, 30 billions in the third quarter, and then 20 billions in the fourth quarter. However, during the March meeting, they decided that in fact they are going to make it to taper faster. So we are going to have 40 billion only in April, then 30 billion in May, and then 20 billion in June, before the purchases conclude at some point in the third quarter. And this is a hawkish development. This is something that we think paves the way for interest rate increases in 2022. And this has also been accompanied by a relatively hawkish message and some quite significant revision to the inflation forecast in 2022. So looking at the March compared to December, the bank expects that inflation will reach 5.1% compared to 3.2% in previous revision. And this is more in line with reality. Looking at the inflation in February, it was 5.9%. It was revised up. It's the highest on record. Also, the central bank made some revisions to growth forecasts. However, they have been relatively minor, so only 0.5% percentage points down compared to 4.2% expected in December. The inflation revisions for the upcoming years have also not been too significant. So the central bank expects a significant shock in 2022 to be materialized in price growth, and which is already materializing in price growth. And then the situation is expected to calm down. However, the central bank has also published adverse and severe scenarios for if the Russia was sanctioned more significantly, or if the market, the economy reacted in a stronger way than expected. And in this scenario, in the severe one, the growth actually is 1.4 percentage points lower than in the base case for 2022, and the inflation is 2 percentage points higher. And the effects are felt in the next few years. European decision makers, not at the central banks, but governments and in the European Union, are still considering further sanctions. So depending on what we are going to get, and also depending on how the war will continue and what will be the outcome, we may get some further sanctions. So it's worth taking into account that the situation may change, and the ECB is acknowledging that. Let's move on to the next slide. As I said, the tone of the meeting has been hawkish, at least in our interpretation, and considering that the APP program has been adjusted, rebalanced, recalibrated. However, the comments that the President Lagarde made and some of the language in the ECB statement was not read as hawkish. In fact, some viewed it as dovish. So one of the key part of the communication is that the hikes are expected to come sometime after the APP end. And Lagarde, during the press conference, stated that this is something that will enable the bank not to be time dependent, but data dependent. and they just want to have flexibility. So we don't necessarily view it as particularly dovish, and we don't think that there will need to be a very significant time difference between the moment that the APP is finished to the moment that the interest rate hikes are actually taking place. We expect that the April meeting will be an important one, and it will bring more details on the end of the asset purchase program. And we expect that interest rate hikes will take place in either June or December, June or September at the latest. The market is pricing in currently approximately 50 basis points in hikes in 2022. And we think that this is a relatively fair assessment, although it's possible that we may get even more than that. In 2023, however, the market's expectations are quite limited, and we think that there is a potential for the market to be surprised and for the ECB to tighten more, which should be supportive of the euro. I'll right now pass on to Matthew again.
Yes, thank you, Roman. And on to the Federal Reserve meeting, March Federal Reserve meeting, which delivered a much more hawkish assessment than most of the market had anticipated. Interest rates were raised as expected by 25 basis points, which is the first hike in a pandemic era. That was fully priced in prior to the meeting. Comments from Chair Jerome Powell were pretty optimistic. He was optimistic on US growth, saying that growth was very strong, and then improvements in the labour market had been widespread. The references to the pandemic were also dropped. Risks there have effectively completely evaporated. But there was a significant upward revision to inflation, with the Fed specifically citing the war in Ukraine. The inflation forecast for this year was revised up to 4.3% from 2.6%, which is a very significant upward revision. Growth forecasts were revised lower as well, actually more so than we had anticipated. Growth is now expected to print at 2.8% versus a 4% projection from December, in large part due to the consequences of the war in Ukraine and also rising US inflation. We think this is a touch too pessimistic, actually. We would say risks to this growth forecast are to the upside, more so to the downside, particularly given the resilience that we're seeing in US economic data. But the most important and significant thing from the meeting was, however, the bank's updated dot plot, which shows where FOMC members expect interest rates to be at the end of each year through to over the forecast horizon, through to the long run. This was revised up very significantly from December. In December, the median dot had expected 3 interest rate hikes in 2022. This revised dot plot now expects 7, which is a massive upward revision. We had actually expected perhaps the dot plot to show maybe 5 hikes this year, and then sort of a more gradual incremental increase in the dot by the next set of projections in a couple of meetings' time. But actually, you know, I've revised up to 7 hikes for this year. That was very hawkish. Signals that the Fed could potentially raise interest rates at every meeting during the remainder of the year. And that's pretty much what Powell reiterated during his press conference. He said that every meeting this year was a live one. There are a remaining 6 FOMC meetings during the remainder of the year. The dot plot suggests that they could raise rates at every one of them if they were to raise rates in 25 basis point increments, as we expect. Although Powell has in the last few days opened the door to even larger moves, 50 basis point hikes. So a pretty aggressive pace of hikes is to be expected. We expect another rate increase in May, and for the bank to follow this up with hikes at every meeting during the remainder of the year. The issue perhaps for the US dollar, and the reason why we didn't see too much of a rally in the dollar following the Fed meeting, is that there is a limit, we think, as to how far rates can go this year. And the market may now, we think, more or less be pricing in the entirety of the hike cycle during the remainder of the year. So that potentially limits upside for the US dollar, is the reason we think as to why we've not seen more dollar strength in the past a week or so since the meeting. And now lastly on to the Bank of England, which was the most dovish of all the big three central bank meetings this month. Interest rates, again, were raised as expected by 25 basis points, the third consecutive rate hike. Again, however, that was fully priced in by the market prior to the meeting. So we did see a sell-off in sterling in the immediate aftermath in reaction to the dovish comments and vote on interest rates. The vote was split 8-1, with one of the members voting in favour of no change. We had expected a unanimous vote. In fact, the market had as well, with at least one or two members voting for a 50 basis point hike. But in the end, we had no members voting for a 50 basis point move and one dissenter. The comments on inflation were also very dovish. The long-term inflation is now expected to fall back materially. And the bank indicated that perhaps to a greater extent than they expected prior to the invasion. So they're seeing the long-term inflationary implications as negative. The big change in wording, though, was on interest rates. The Bank of England changed its comments on additional tightening, saying that now additional tightening might be appropriate versus likely to be appropriate in the previous statements. This might seem like a very minor change, but actually we think it's quite significant. We think that now potentially a pause in the hiking cycle could be on the way. Maybe not from now on, but maybe after the next meeting in May. And we think it's going to be quite difficult for the Bank of England to raise rates as aggressively as the market is pricing in. But as we've been saying throughout this presentation, risks of inflation are very much skewed to the upside. The Bank of England expects inflation to exceed 8% in Q2. It could even go higher later in the year, particularly following after the removal of the energy price cap in April. So we think that further hikes are required. We expect another 25 basis point move in May, with additional hikes during the remainder of the year, albeit, as I mentioned in the previous slide, the MPC may well pause the hiking cycle at some point in the next few meetings. MPC members appear much more concerned with the impact of rising prices on growth than we had anticipated, particularly the increase in commodity prices out of the bank's control. And so, as I said, the Bank of England might find it difficult to keep up with market pricing. The market continues to price in. It's around about 125 basis points of additional hikes through to the end of this year. That would mean 5 interest rate hikes in the next 6 meetings. We think that could be a little bit of a stretch now following this dovish turn from the bank, albeit we're in an environment where things can change very quickly. A couple of inflation prints that massively beat expectations. We could be back to a scenario where the Bank of England turns hawkish again. So it's a very sort of fluid environment, a very uncertain one for all these major central banks. And we'll continue to be paying very close watch on upcoming inflation prints and the central bank meetings, which are now more important than they have ever been, really. But that's it in terms of content. I will now open the floor to you guys. If you do have any questions, please feel free to post them in the Q&A function in the Zoom app, and we'll try and get around to answering them. I usually take this as a good sign. If there's no questions, that usually means we've covered everything. But if you do have anything, we'll give a couple of minutes. If you do have anything that you would like to ask, please feel free. We have one which is on the Swiss franc. Perhaps, Roman, this might be one that you can answer, given this is a currency you follow very closely. What are your expectations for the currency?
I mean, we generally expect the situation with regards to sentiment to improve, and we think that some form of a ceasefire and stop to war We hope it can be achieved in the next few months, and the markets are also seem to be quite optimistic on that. However, the prices are not yet fully reflecting it, so we expect the Swiss franc to continue to remain pressured as it has been in the past days, and we expect the euro franc to increase. I don't think we are going to change our forecast for the euro franc significantly, if at all. We think that the trend for the currency is down.
Yeah, I concur. We have one on whether it'd be a good idea to hedge if we need US dollars. We tend to steer clear of any sort of advice on hedging strategies. What we can say is at the moment, the dollar is at pretty elevated levels, ran about just shy of its highest level since May 2020. We're still pretty optimistic on global growth this year and a recovery in risk sentiment. So I think we're still of the view that we're bearish dollar, but perhaps slightly less so than we were prior to the invasion, though, particularly given the Federal Reserve's hawkish turn at its March meeting. We also have a question about the Polish zloty. Again, Roman, I might have to pass over to you on this one. So do we have any expectations for PLN currency performance?
Yes, so as with other risk assets that have been battered by this situation, maybe excluding the Russian ruble right now, we expect the zloty to appreciate. We will be revising downward our zloty forecast in the coming days. However, we think that already the currency has rebounded quite significantly. It's 4.7 versus 5. However, it still carries some of the risk premium. In addition, if you look at all of the deterioration that the war in Ukraine is doing to the Polish economy, we need also to take it into account. So we think that it will affect the currency both short term and the longer term. So the levels that we expect to see will not be as, we are not going to see as much appreciation for the zloty as we expected prior to the invasion, but the trend in our view is still going to be the same. But this will largely depend on how the situation with Ukraine will go.
We also have a question on when do we think investors will return to more risky investments? Actually, what we've seen so far is that risk sentiment has improved quite significantly in the past couple of weeks or so since the peak of the downturn. The news that we've had out of the peace talks between Russia and Ukraine have generally been quite positive, despite the doom and gloom headlines that we're having out of the conflict itself. So actually, a lot of these higher risk investments have already rebounded quite nicely, particularly those emerging market currencies. A lot of those Central and Eastern Europe, particularly we've talked about in depth, have rebounded very sharply. But until we get sort of more concrete news on a ceasefire and some sort of idea as to when we might get the ceasefire and how the peace deal will take form, these currencies remain a little bit sensitive to a sell-off. I think until we get concrete news on that, we won't see a significant move higher in risk currencies just yet. But very difficult, obviously, for us to tell when that will take place. And we also have a question on the pound to euro exchange rate. Will the pound get stronger to the euro? We're sort of in the midst at the moment of revising our view for both the pound and the euro, actually. We're slightly less bullish on both currencies in light of the war in Ukraine. We think that both of them, given the fact that European currencies slightly more closely linked to the conflict in Ukraine, that could weigh on their economies, which is negative for the currencies. Actually, though, I think we're slightly more bearish now on sterling versus the euro than we were previously. I can say that at least, given what we've seen from the Bank of England. The hawkish, the dovish turn that we saw from the Bank of England's March meeting, we think is significant, whereas we think that the ECB may well exceed market expectations this year. The Bank of England could undershoot them. So that, we think, has skewed the risks towards a slightly more stronger euro versus sterling. Okay, great. I think that's mostly all the questions we've got. We've had a few regarding whether we'll share the presentation, which we will do following today. So yeah, please feel free to look out those. We'll send those, I think, in the next couple of days or so. But I think that's everything. I think we'll wrap things up now then, as we've just moved past the hour mark. So yeah, again, thank you all very much for joining today. Apologies again for the audio issues at the beginning of the presentation, but we hope you enjoyed the rest of the presentation. And again, we'll be doing one of these. Try and do these on a quarterly basis. So we'll look out for invites in the next sort of month or so for our next one. But thank you everyone for joining.
Thank you.